Good evening, everyone, and thank you for joining us for this week's episode of Building Better Business, a practice management web series brought to you by Fiscal. Today's episode is Bookkeeping 101 with our guest speaker, Dawn Gonsalves. Hopefully I pronounced that right.
That was good.
Thank you. My name is Natalia Morrison, and I'm the Director of Communications here at Fiscal, and just like you, I'm also a licensed acupuncturist. Before we begin, let's go over some housekeeping. This episode is being recorded and will be available on our YouTube channel. Be sure to like and subscribe to our channel to see all our videos and be notified when new webinars are posted. Please note that the information shared in tonight's episode is by the speaker for educational purposes only. The views expressed by the speaker are those of the speaker and not necessarily those of Fiscal. We will be holding questions until the end of the presentation tonight. Please submit your questions in the Q&A icon found in the bottom of your screen. So without further ado, welcome, Dawn. Thank you for joining us today.
Well, hello, everyone. My name is Dawn Gonsalves, and I'm going to go over the basics of bookkeeping. Every business owner needs to keep accurate and timely accounting records. So good bookkeeping is a vital part of the business. Natalia, how do I pick up my screen again?
At the bottom of your Zoom window, there should be a green button that says share screen.
Okay, got it. Thank you so much.
Perfect.
All right, everybody, this is my first time doing this, so if it's a little rocky, please bear with me until I get the hang of it. Well, I'm a certified public accountant, and I have an MBA in business organization and management. I'm currently the chief fiscal officer for a public education nonprofit organization, but I've spent 10 years in public accounting, along with being the owner of 2 small businesses. One of my businesses is providing bookkeeping, accounting, and tax preparation to individuals and small businesses. I actually decided to go back to school later in life to be an accountant after selling one of my businesses. After the bill of sale was signed and my husband and I submitted our tax return to the IRS, we were shocked to find that almost all of our profit from the sale went to pay capital gains taxes. We had no idea what capital gains taxes even were, and everything that we had planned to do with the proceeds went down the drain. We had never consulted with anyone regarding the sale because we didn't see the point in spending money just to sell the business. After that, I was determined to learn more about accounting and the financial statements that would have served as a tool for running the business more effectively. So what's bookkeeping? Simply put, bookkeeping is the recording of a business's financial transaction. Any transaction with financial implications needs to be recorded by a bookkeeper. It sounds fairly simple, but for a beginning, the introduction of bookkeeping specific vocabulary and the rules that govern proper bookkeeping processes can be really overwhelming. Accounting and bookkeeping can be a bit intimidating to someone who isn't used to it, but I'll be trying to simplify it so that you can ultimately have some tools to run and grow your business. I will go over the basics of bookkeeping, the types of accounts used in bookkeeping, and the different types of financial statements. We'll also go over whether to do the bookkeeping yourself or to outsource that part of your business. If you decide to do the bookkeeping yourself, I'll bring you through the process of keeping manual records. That right there may be enough to help make the decision to use an accounting software. So I'll provide information on some software choices if you decide to go that route. So bookkeeping isn't just busy work. Benjamin Franklin said, "Beware of a little expense. A small leak will sink a great ship." If you're not paying attention to your income and expenses, something small but wasteful can eventually cause a problem in your business. You may think that the business is healthy, but by not being knowledgeable about your financial statements, it may be too late by the time there are other signs of distress. But staying up on top of things, using your tools, and understanding your financial statements, you can clearly see when there's a problem and get the hole patched before your great ship that you worked so hard to build up ends up sinking. So bookkeeping It's an essential part of money management. If you don't have a roadmap, how do you know where you're going? Are you profitable? Do you have a loss? With timely book record keeping, you can catch problems early and mitigate business risk instead of reacting after the fact. The ability to maneuver helps build the business's financial foundation. And that financial foundation is where you base your business decisions. If you see trouble coming, you can make better business decisions. You can evaluate what you're charging for your services and products and look for waste in spending. If the business is growing, you can more easily evaluate if the business can support a larger office. If you need an infusion of cash to keep afloat, you can evaluate if it would be beneficial to introduce another professional to your business that will enhance it and share in expenses. You may also more easily determine if you need to work for someone else for a while until you can build your patient base. The goal of a business's data is to be current, organized, and reliable. Make sure transactions are being recorded on a regular basis to stay current. If you're going to hire a third party, make sure that you provide information to them in a timely, systematic manner. Keep your information organized to make it easier to record all of the transactions, which will provide reliable data for the company that the owner can rely on. When planning your business, you have to decide how you're going to tackle the financial records. Every business needs to have a structured method of recording the money coming in and going out of the bank. The question is whether or not you, as the business owner with limited knowledge, wants to do this job yourself or hire the services of a professional. If you have enthusiasm, patience, and time, then your answer should be yes to doing it yourself to start with. You might also be motivated by your desire to keep your costs down. That being said, it can also be a daunting task if you're not good with numbers, or if the task is extremely stressful to you, because then you start ignoring it, or you don't have time to get it accomplished. Or if your business is growing rapidly and you find yourself trying to juggle all the different aspects of the business, then outsourcing the work to a bookkeeper would be a really good idea. So what exactly does a bookkeeper do? An outside bookkeeper will only enter transactions into your or their software, reconcile the accounts, and produce basic reports. If you do it yourself, it'll involve all the other aspects, such as invoicing clients, paying bills, entering and categorizing the day-to-day data. So it's a little bit more involved when you do it yourself. If you hire an accountant to do the work, they are professional, they usually have a business degree, they do your account analysis, and they give you financial guidance and advice. But it's also going to be more costly because of their education, knowledge, and qualifications. But really, they also provide valuable financial advice and guidance for a fee. So why should you consider spending the money and hiring someone else to do the record keeping? And the answer is usually because keeping up with the transactions takes time away from critical business functions such as marketing, networking, and building your business. A professional would be accurate and reliable, and therefore produce accurate and reliable reporting to help run and build your business. You'll have less business risk and more timely tools to help mitigate risks. So who should you hire? How do you know who to hire? So the bottom line is that bookkeeping mistakes can be costly, and hiring the right bookkeeper for your small business is essential. Don't make a mistake and hire the cheapest bookkeeper, believing that bookkeeping is strictly data entry. Hire a qualified and knowledgeable bookkeeper who will set your business up for success. Get referrals from your tax accountant, your colleagues, and from anyone within your network. Rely on word of mouth because that's the best way to go. How much would it cost to hire an outside bookkeeper or an accountant? Well, a bookkeeper would be the most economical at $25 to $50 per hour based on their qualification. And for a general guideline, it would take approximately a half to one full hour for a skilled individual to enter a month's worth of transactions. If you mix your personal expenses with your business expenses in your bank account or credit card, it would take them even longer to do a month's worth of work. If you hire an accountant or a CPA, the cost would be anywhere from $50 to $200 per hour based on their location and their qualifications. So there's 4 main bookkeeping steps that you should really follow. Set up your chart of accounts and become familiar with them. The second is record all of your financial transactions on a regular basis. Reconcile the bank accounts and the credit cards monthly, and then close the month and run the financial statements. If you follow those 4 steps, you should be in really good shape if you're going to do it yourself. So let's go over the types of accounts that come into play for your business. We'll start off with the balance sheet, as that financial statement is the true picture of how your business is doing. Most people don't know how to read their balance sheet, and so they're missing out on a very valuable tool. The balance sheet lets you know quickly whether you're making money or losing it. A balance sheet is a straightforward but crucial financial document that balances your assets against your liabilities and equity. Luckily for the busy business owner, they're pretty easy to create and read. One half of the sheet lists what your business owns, while the other half lists how much you owe, along with how much of the company you own. The information on a balance sheet gives you your lenders, your investors, a quick overview of your business's current financial health. In other words, when you need to take your business's temperature, a balance sheet is your thermometer. And along with a profit and loss statement, which is also called an income statement, a balance sheet is one of your business's most essential financial documents. You'll be drawing up a lot of balance sheets, and if you want your business to stay in the black, you need to know how balance sheets work, how you read them, and how you can create your own. So that brings us to the different kinds of bookkeeping accounts. You really need to know and understand these. These accounts and their sub-accounts make up the company's chart of accounts. Assets, liabilities, and equity makes up the accounts that compose the company's receivables. The balance sheet, and the assets are what the company owns, such as inventory and accounts receivables. Assets also include fixed assets, which are generally buildings, equipment, and land. If you look at the format of a balance sheet, you'll see the asset accounts listed in the order of their liquidity. So cash comes first because cash is perfectly liquid. After the cash account, there's inventory, receivables, and fixed asset accounts. Liabilities are what the company owes, such as what they owe to their suppliers, the bank, business loans, mortgages, and any other debt on the books. The liability accounts on a balance sheet includes both current and long-term liabilities. Current liabilities are usually accounts payable and accruals, and accounts payables are usually what the business owes to the suppliers, credit cards, and bank loans. Accruals are taxes that you owe, like sales tax. Like if you sell product, you're going to owe sales tax on that. So that's an accrual. Payroll taxes are the same way. Long-term liabilities have a maturity of greater than 1 year and include items like mortgage loans. Now, equity is the investment a business owner or any other investors have in the firm. The equity accounts include all of the claims that the owners have against the company. The business owner has an investment, and it may be the only investment in the firm. If the firm has taken on other investors, that's reflected in the equity section. When you subtract your business liabilities from your business assets, that is what equity is. So think about equity in your home. The more you owe on it, the less equity you have in the house. And if you keep taking out second mortgages, your equity keeps dropping even more. So it's important to leave money in your business because that builds your equity. So when you're looking at a balance sheet, assets minus liabilities equals your equity. So it's everything the business owns, your assets, minus everything that you owe, the liabilities, and that equals the equity in your business. So then that brings you to the income statement. It's also called the profit and loss statement or a P&L. The income statement is developed by using revenue from sales and other sources, then your expenses and costs. It shows the profitability of your business for a period of time. It provides insight into the operations of the business, the efficiency of the management, and you can benchmark yourself against the competition. There's a lot of valuable information in the income statement when you understand what you're reading. When you subtract all the expenses from your revenue earned in the same period, your number will be either positive or negative. If the number is positive, that means the business has earned a profit in that period. If the number is negative, that means the company has incurred a loss. Profits need to be consistent for a business to stay afloat. Occasional losses can be absorbed by the company if the company is in good financial position. But if you're continually struggling, losses are going to be felt a lot faster. So the accounts within the profit and loss statement or income statement, most important one is the revenue. The revenue is all the income a business receives in selling its products or services. And then costs, also known as cost of goods sold, is all the money a business spends to buy or manufacture the goods or services it sells to the customers. And so the purchases account on the cost of on the chart of accounts usually tracks your goods purchased. Expenses are all the money that's spent to run the company that's not specifically related to a product or a service sold. An example of an expense account is your salaries and wages, your rent, your phone, payroll, utilities, and all different kinds of administrative expenses. So now that you're familiar with the types of account categories, you need to determine what the sub-accounts are, such as utilities, rent, office supplies, advertising, etc. So software has standard charts of accounts that can be personalized. But when you're doing it manually, you have to develop a chart of accounts, which you will need to become familiar with. Your chart of accounts is the backbone of your business, and it's a necessary piece in order to properly record transactions. While you can certainly buy a ledger book at an office supply store, keep in mind that it's really much easier to set up your chart of accounts if you're using an accounting software, such as QuickBooks. I do have a sample chart of accounts for a medical practice that I'll make available. Just let Natalia know that you'd like it and she can send it off to you. So don't fall into the trap of thinking that you need a sub-account for every little thing. That makes it even more time-consuming to keep your books, and it'll produce reports that'll be harder to read and analyze. So you need to find the right balance between creating a chart of accounts that organizes transactions in broad categories and also provides the level of detail that you need in order to make informed business decisions. So now that you've done that, you're ready to start recording your transactions. There are different methods to use. Some are quite inexpensive, but are more time-consuming. Some are a little more expensive, but can be time-saving and also make some items easier for a beginner. The least expensive but more time-consuming method would be to manually write the transactions in a ledger book. A ledger book is best if you don't have a computer or internet and your business is very small. The other option is to purchase a basic accounting software. Software makes the data entry simpler once you figure out how to use the software. If you don't know how to use the software, it's easy to mess things up really fast. But the good part is that it's easy to produce reports, which helps provide an accurate picture of your business, and they are great tools. In this class, I can't teach you how to use accounting software because they're all different, and I'm not quite sure what everybody is going to be using. If anyone's interested, maybe we could offer a QuickBooks basic training in a future class, as I'm an advanced QuickBooks Pro advisor. But today, I'll be reviewing how to set up a ledger book for manual entry. The philosophy behind a ledger book is the same philosophy that all the accounting software uses, so you can apply this to either method that you end up using. The first step is to purchase a ledger book or use Excel to create a ledger. You'll want one page for each type of expense, or you could use a half a page for your accounts if you feel like there'll only be a few entries for the year. You'll need a column set up for the following items. So write the name of the account on the top of the page so that's easy to find, and then designate a column for the date of the transaction, the check number, the description of the transaction, and then you're going to need a column for the debits, a column for the credits, and then one for the running balance. Then you'll need a monthly summary page and then an annual summary page. So be flexible and update your ledger's formatting as you become more familiar with it to best meet your work style. Also, make sure to reconcile your ledger often. In accounting, reconciling a ledger means reviewing your ledger for correctness. By making a consistent habit of checking your financial history for accuracy, you can reduce the potential for mistakes that could affect your business's profits. Remember, a ledger is a tool to benefit your business. A well-maintained ledger is important for ensuring the success of your business's bookkeeping. The general ledger uses an accounting method called double entry accounting. This means that for every entry a business makes in one of its accounts, it makes an opposite entry in another account. Double entry accounting system ensures that every debit in one account has a matching credit in another, making it easier for a business to track its transactions and identify mistakes. Modern computer software like spreadsheets and accounting systems makes the process even easier by using embedded codes to calculate these numbers automatically. So debits are positive numbers, and they're used to increase your assets and expenses and decrease liabilities and revenue. Credits are negative numbers, and they're used to increase your liabilities and revenue and decrease your assets and expenses. So I'm going to give you some guidelines on debits and credits. Generally, if you're adding an expense, you would debit the expense, which adds to the expense, and you're going to credit the bank to show that it reduced your bank account, or your credit card to show the increase of what you owe on your credit card. Again, your software will handle the second side of the entry if you're using software. So here are some examples of how the debits and credit works. To add an expense, you're going to debit the account, credit the bank, cash, or credit card. And to add income, you're going to credit that account, but you're going to debit the bank, cash, or credit card. To pay a loan, you're going to debit the account and you're going to credit the bank. To record purchase of an equipment, you debit the account and you credit the bank, cash, credit card, or loan. So you see the two sides of an entry. So if you're going to record that you paid your rent for the month, you're going to add an expense. So you're going to debit the account. But then you have to show that it comes out of your bank. So that's where you have to put an entry in to show the money coming out of the bank. So after you've entered all of your transactions for the month, you should then reconcile your bank account and your credit card statement. And the purpose behind completing a monthly reconciliation is to see what checks are still outstanding. You post any bank transactions and then add additional charge like bank fees or credit card fees. Reconciling provides you with an accurate cash balance, which can be particularly important to smaller businesses with limited cash flow. One of the advantages of using accounting software is that much of the reconciliation process is completed by simply linking your bank accounts to your software of choice. And this allows easy daily or weekly reconciliations, making the month-end process that much simpler. So if you opt not to link your software with a bank, you'll need to reconcile your accounts manually. Whichever way you do it, it's important to complete the process on a regular basis. So now at the end of the month, you need to close it out you're going to subtotal all of your expenses, and you're going to subtotal all of your revenue, all of your accounts, and you're going to transfer the subtotals to the monthly summary page. So once you do that, it's going to give you your profit and loss statement for the month. So financial reporting, again, it's an important part of the bookkeeping process because the statements provide you with an accurate view of the financial health of your business. And then you can share that with your accountant or your CPA. Then at the end of the year, you transfer all of the monthly subtotals to your annual summary page, and then you're going to be able to see how your business did for the year. And once you close out your year, you're ready to send it off to your accountant for tax return preparation. So if you use accounting software, it's going to give you a more accurate picture of your business. While accounting software can feel intimidating to those with no bookkeeping or accounting experience, many products are designed specifically for the financial novice. So the two that I usually suggest is the QuickBooks. You have QuickBooks Desktop and the QuickBooks Online. And both of these have a lot of positives to it. All accountants and CPAs have the ability to use QuickBooks. Most of them have the software, and you can just send your file off to them and they're ready to roll. You can also do customer invoices out of both types of QuickBooks. Customers can pay their invoices online for both of these QuickBooks, but additional fees do apply. You can keep track of bills that you owe to vendors and then pay them through there. Both softwares have check writing capabilities, and it's wonderful in QuickBooks because when you write a check, it does both sides of your entry for you. So you record the check, it records it to the correct expense account, and it shows it coming out of your bank. And then both of them also have the ability to connect to the bank to download transactions. And that saves an awful lot of time because your bank will actually feed every single transaction into your bank register, and you just look them over, make sure they're in the right categories, and now they're in your register, and all you have to do is reconcile. And at that point, it's done its own reconciliation, so it's hardly any work at all. But the two, I'll give you some pricing on these two types of accounting software. So the accounting software for the online QuickBooks, well, the desktop is first. Desktop Pro is $350 per year. QuickBooks used to let you just buy one copy and use it for years and years, but they've smartened up. Now they make you pay for it every single year. But it's still a good price to have all your bookkeeping done. It's less expensive than hiring a bookkeeper or an accountant. QuickBooks Online, that one is about $25 per month for Simple Start, and that's good for small businesses. And the Essentials is $50 per month for larger businesses. You can access it anywhere. You can be on vacation and log into your account and do some bookkeeping if you want. Or you can also provide a bookkeeper or an accountant with accountant's access, and they can actually log on to your QuickBooks, enter in transactions, or review your transactions and clean it up for you. So both of those are pretty good. So that's all I have tonight. And I found this balance sheet of life that kind of sums up what accounting is in relationship to your life. And so I thought it would be easier to understand what some of these phrases or terminology means. So what comes to you is credit, what goes from you is debit, birth is your opening stock, death is your closing stock, your ideas are your assets, your bad habits are your liabilities, your happiness is your profit, your sorrow is your loss, your soul is your goodwill, and your heart is your fixed assets, your character is your equity, your knowledge is your investment, and your age is your depreciation. And always remember, there's an ever-present auditor watching everything. So that's all I have for tonight. Does anybody have any questions?
That was so great, Dawn. Thank you so much. And I love this balance sheet of life. It's wonderful.
Now we're going to be doing a budgeting class on February 27th, and I'm going to actually have an Excel-based pre-made budget worksheet for anybody who would like one at that time. But everything, budgeting goes hand in hand with your bookkeeping. And if you don't budget, you really don't know what you're going to be doing with your money. And so if you're doing your bookkeeping, you can set a budget, and a budget doesn't make you have to earn more money to cover your expenses. What it does is it helps you make the most of what money you do have. So it's really important to start out with your bookkeeping so that you know what your expenses are and you know what your revenue is. And then you know how your business is going and where you want to bring it. But so any questions?
Well, let's see if anyone has questions. Your presentation was so detailed, was really well organized. I really enjoyed it, and I'm definitely going to watch it a couple of times, make sure I have all my notes done, because it was really
Okay.
cool.
And if anybody has any questions, reach out to Natalia, and then she can reach out to me, and I'll surely try to answer anything that comes up.
Wonderful. Thank you. So far, no questions are coming in.
Okay.
And I think that's because your presentation was very detailed. So yes, like Dawn said, if you have any questions, feel free to reach out to us at support@fasoma.org, and we will contact Dawn on your behalf with your question and get that answered for you as quickly. And there's a comment that says, thank you, Dawn.
All right. Well, thank you everybody for participating tonight. I've enjoyed it. Thank you.
And we'll see you next month for Budgeting 101.
Okay. Thank you.
Wonderful.
Bye-bye.
Good night, everyone. And thank you for joining us and supporting Fasoma. Good night.